We got some massive news for Symbotic stock investors as the company announced that it will be unable to file its annual report for the fiscal year ended September 28th on time. Now, this is similar to the trouble that Supermicro computer stock finds itself in, but there are some big differences and there are some similarities. I'll highlight those in this video here. I'll also update investors and let you know if I think this is a buying opportunity because as a result of this announcement of the delay and restatement of its financial results, the company's stock price is down over 35%. So is that dip a buying opportunity? I'll answer that question as well. And I'll go into the details of why these kinds of situations arise and why our accounting system in the United States results in some of this murkiness that ends up resulting in these financial statements restated and adjusted. So let's take a look at the details and evaluate what this could mean for Symbotic stock investors.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
All right, so Symbotic determined that it's unable to file its 10K for the fiscal year 2028 without unreasonable expense or effort. Additionally, management has identified certain material weaknesses in its internal reporting. The company identified occurrences during fiscal year 2024 where goods and services, primarily relating to specific milestone achievements, were expensed prior to the time that the corresponding milestones were achieved. This resulted in acceleration of the recognition of the cost of revenue. Additionally, given that Symbotic recognizes revenue on a percentage of completion basis, this resulted in the acceleration of recognition of revenue. Okay, for those of you that are watching that are not CPAs and not accountants, you're probably wondering what all of this means and why are they allowed to do this kind of stuff and how does this even happen? So this all goes back to the way accounting statements are structured. What might be against your intuition, the company doesn't recognize revenue when it gets money, right? So you might think, okay, Symbotic makes a sale, the customer gives them $100, that's $100 in sales revenue, right? Wrong. That's not how it works. When Symbotic makes a sale and it gets $100, it doesn't recognize that as revenue. It recognizes that as revenue when it performs the obligations contracted for in that agreement. The example I like to give is with a magazine subscription. Let's say you buy a magazine subscription for the year 2025 and you pay right now $100 for that 2025 subscription. That magazine company will not recognize that $100 as revenue right now. It won't. It will account for that in some other way. It might say unearned revenue or deferred revenue or something other than actual sales right now. That magazine company will then recognize revenue each time it sends you a magazine. So let's say it's for a monthly subscription, 12 months in 2025. When it sends you one magazine, then it will account for the revenue on a fractional basis, 1/12 of that $100 that you received. And on until the end of 2025, until that last magazine they send you at the end of 2025, will they finally account for that full $100 that they received will actually turn into revenue. So that's like Symbotic right now. They have such a backlog in orders and they've already received a lot of the money for those orders and they recognize those orders as revenue when they perform that obligation in the contract, right? When they hit certain milestones on turning these warehouses into automated facilities. And so with each step, or they have a contract where, when they hit a milestone, they can recognize revenue. Then they hit another milestone, then they can recognize revenue again. So what management is saying here is that they recognized revenue faster than they should have. So in the magazine example, that would be like taking 4 months of revenue before you delivered 4 months of magazines. Maybe you recognize 4 months of revenue after you send the first magazine out, right? So you're actualizing revenue sooner than you should have. That's what Symbotic is saying it did. Now, it may not have done this on purpose, and it may have, they might have aggressive practices in revenue recognition, but most likely what happened here is that the systems are so complex that it led to a systematic problem where they're recognizing revenue faster than expected. And they admitted that in the statement that there's material weakness in their internal controls in the way they're recognizing these revenues, these costs as they accumulate here. So that was on November 18th. And then on November 25, Symbotic identified errors in his revenue recognition related to cost overruns that will not be billable on certain deployments, which additionally impacted system revenue recognized in the second, third, and fourth quarters of 2024. This is more troubling. This is cost overruns that the company experienced that's not going to be billable. This is not going to be recognized as revenue. This is in, keeping with the magazine example, this is in you made a deal to sell $100 worth of magazines, and then after the first 2 months, you realize that it's going to cost you more to deliver these magazines than you initially thought, and you're not able to charge the customer anymore because you already made the agreement for $100. You're not going to be able to charge the customer more because your costs were higher than you initially expected. That's what happened on November 25th, and that's more troubling than what they're announcing happened on November 18, which is just an acceleration of revenue recognized. This is costs that the company incurred that they thought they were going to be able to bill to the customers, but it turns out they're not going to be able to bill those costs to the customers. And so this is just going to hit the company, and it's just going to be added cost to serve those deals that they had already made. So overall, the company expects the total impact of correcting these errors will be to lower revenue, lower gross profit, lower income before tax and adjusted EBITDA by roughly 30 million to 40 million for the fiscal year 2024 compared to their actual results that they released on November 18. So $35 million at the midpoint. Okay. So let's take a look at their actual results and let's see how meaningful of an impact this is, $35 million. So for the full year 2024, the company reported revenue of $1.8 billion. So in terms of revenue, the 35 million is not a big deal. But when you look at the profitability, the adjusted EBITDA, they reported 96 million of adjusted EBITDA. So a correction of 35 million is roughly 33% of the adjusted EBITDA they delivered in 2024. So roughly 33% less profitable than they initially told investors they were. And if you look at the price, it's down about 35%, right? So very close to the actual impact on the company's financial statements. The stock price accounted for that, adjusted for that impact here. Additionally, the company updated its forecast for what they think they'll achieve in the first quarter, which they now expect 490 million in revenue and 14 million of adjusted EBITDA. Again, let's go look at the previously stated numbers and let's see how big of an impact this is. So previously they were forecasting about 505 million at the midpoint in revenue and about 29 million at the midpoint in adjusted EBITDA. Keep those numbers in mind, 505 million and 29 million. Now you look at it revenue now, 490 million and 14 million. So on the revenue line item, about 15 million less in revenue expected in the next quarter, and just about the same, 15 million less in adjusted EBITDA expected for the next quarter. So these are quite meaningful impacts to the company's revenue and profit numbers. Well, not so much the revenue numbers, but the profit numbers. These are quite meaningful impacts to the company's profit numbers, as they will have to eat these costs and not be able to charge their customers more just because they experienced these cost overruns. Additionally, these restatements raise concerns from investors about the company's internal controls and management quality because they're having to restate these financial statements. And this is a loss of confidence, to be sure. You never like to see this from any of the companies that you're following. Now, I mentioned that this is similar to what's been happening at Supermicro Computer, and a little bit different. So Supermicro Computer also said that they're delaying their financial statements, but they haven't said that they're going to need to restate them. They haven't said that revenue is going to be lower and profits are going to be lower, right? That's the risk with Supermicro Computer, is that they're going to have to make this kind of adjustment and tell investors that, you know what, our revenue and profit, it's actually lower than what we initially reported. And so that's what investors are waiting for with Supermicro Computer. We haven't yet gotten that update. If they come back to investors and say, everything is fine, we don't need to restate anything, then the big risk is kind of alleviated. So that's where there's the difference between Symbotic and Supermicro Computer. So all that being said, is this a buying opportunity, right? Because I've had Symbotic stock rated as a buy up until these announcements, right? I've had this stock rated as a buy. But these announcements are concerning to me. The stock price is down by roughly 35%, but so is the profitability. It's down by roughly 33%. And then you have the added impact of the concerns about the internal controls and management quality, etc. So to me, those are big concerns, and I don't think the stock price decrease is enough to justify those concerns and the restatements of the financials. So I am going to downgrade Symbotic stock to a borderline buy, and this is no longer a straight out buy. Now I'm kind of on the fence about this, whether I think it's a buy or a hold. It's kind of in the middle there, closer to a buy still, but I'm a little more concerned about Symbotic stock, of course, following these announcements. So I'll update this recommendation today, November 27, and unfortunate news for Symbotic stock investors. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.